Welcome back. This is the big story here on the BDTV Breakfast Show, and this is where we discuss key issues shaping our nation and our economy. My name is Elizabeth Musa, and today we'll be exploring the impact of the Monetary Policy Committee's decision to retain rates in 3 years. Our discussions will focus on what this move means for the economy and businesses in Nigeria. The Monetary Policy Committee of the Central Bank of Nigeria retained the country's benchmark interest rate at 27.5% following its 299th meeting in Abuja. The decision marks a pause in rate hikes after 6 consecutive increases in 2024 as the Apex Bank navigates inflationary pressures, exchange rate volatility, and economic growth concerns. The committee noted stability in the foreign exchange market, improvement in external reserves, and a gradual moderation in fuel prices as key macroeconomic development influencing its decision. Now, to understand this better this morning, we're joined by our in-house analyst. I'm joined by Lolade Akimurele and as well as Eniola Olatunji. Good to have you on the show this morning.
Pleasure to be here.
Well, let's go straight to the conversation. First, let me start by asking you, Mr. Lolade, can we know why the MPC decided to take this decision?
Yeah, so like you rightly said, it's the first time in 3 years that they are retaining interest rates. Throughout, for the most of last year, we had massive hikes culminating in, what the current interest rate level. I think we had a combined rate hike of about 875 basis points last year. So I think the reason why they decided to hold now is because, we're coming off the back of a rebasing for inflation figures, right? So the numbers that we got for January was 24.48%, down from about 34% in December 2024. Now, using the NBS did not release data on the old methodology. So what that means is that the 24.48% that we had for January is, it's rebased, it's different. It's not what would have been the case if we still stuck to the old methodology. Perhaps we might have even seen a hike, I don't know. But the CBN, the MPC decided to just hold off, watch, see exactly, since these new figures have not really settled in yet, see when the NBS is able to release the data using the old methodology, and then that they can make more informed decisions off of that. But to make a decision based on what we saw in January, given that they are rebased figures, would have been hasty for me. Yes, of course, we've also seen some stability in the FX market. That might probably have given them another reason to decide to hold interest rates. But as we noted earlier, I think BusinessDay did quite a number of stories just looking at how the Naira rally we're seeing today, we had something similar last year, and it all came crashing down eventually. So it's good that they decided not to get carried away too much by the appreciation we're seeing in the foreign exchange market, and just decided, let's stick to our guns here. Let's hold the rates where they are and then see what happens going forward.
Right, I'll come back to ask you, because we need our listeners to be, our viewers to be very informed, I'll come back to ask you on what exactly the CPI rebasing actually means, for like a layman. But Eniola, to you, what does the 27.5% interest rate mean for businesses?
So obviously there was no change in like the interest rates, and that means it's status quo. So businesses will still be borrowing at the same rates at which they were borrowing in the past. But there's something good to notice. So in the treasury bill market, rates have been dropping, and so this means two things for portfolio managers and traders. For traders, they would be sad that the rates are dropping, but for not portfolio managers per se, but people that borrow, like business that like to borrow through commercial papers, they can now offer lesser rates for their commercial paper now that rates in the 1-year treasury bill are dropping. So for businesses, they can borrow at a lesser rate, although the MPC rate is the same thing, but because rates on the treasury bills are now dropping, they can borrow at lesser rates. But when it comes to banks, the rates are the same because they held rates across all of the rates at the same level. So yeah, for those borrowing at the bank, they will be borrowing at the same rate. So things are still relatively really the same. But maybe for commercial papers, you could see maybe rates on commercial papers begin to reduce, because even in the bond market today, there's a bond auction today, and everyone is projecting that this is the last time we might be able to borrow at the bond. We might be able to get bonds at 20-something%. last week we saw treasury bill fall to like 23%. So it's different for different people. If you're borrowing from the bank, status quo. But if you're probably going for commercial papers or other things, it might reduce. You might be borrowing at a lower rate.
At a lower rate. All right.
Yeah, and just to add to what she said, she alluded to the fact that now you have a situation where you have positive real returns for the first time in over 5 years. So even though that's on paper, because the T-bill yields has dropped to 23% as at the last auction last week, but on paper it's a good signal to send to investors that indeed we're on the path of orthodox monetary policy. So the central bank governor has committed to ensuring that we have an environment where interest rate is above inflation, because that's the only way you can cut foreign investors into the economy. That will bring in the dollars that you need to stabilize the naira. So it's a good thing that we have now finally joined the league of other African countries with positive real returns, because if you look at South Africa, Kenya, Ghana, Egypt, they all have positive real returns, and they've had that for close to a year now. So it's good that we finally turned the corner, even though we know that most of that is down to the rebased
and is this the first time that this is going to be happening? Is this the first time
that what is happening, that we have interest rates above inflation? It's the first time in 5 years.
Oh, really?
Yeah. So before now, you've seen we've had a case where inflation has been above interest rates. So that has left investors with negative real returns. So when they are doing their calculations, what to invest in, because you know that you have to back out inflation to get your real return. So if you back it out and then you're left with a negative figure, it's enough reason for investors to decide not to invest in Nigerian assets. They go elsewhere. They go to Egypt. That would probably give them positive return. So now that it's positive, or at least on paper, the reason why I'm saying on paper is if you compare the current inflation rate is 24.48%, right? Percent. You compare that with the rate on the 1-year treasury bill, which is 23%. The 1-year treasury bill is actually lower than inflation rate. So that's why I said it's on paper that you have MPR 27% and then inflation 24%. So it's positive. It's a good signal to send, and it's a sign that we're moving in the right direction.
And speaking of a good signal to send, what are some of the implications of this for Nigeria's economy and manufacturing? And let's speak about it, both the positives and the negatives, because I'm sure there will be negatives as well.
Yeah, good. So I don't. I mean, the Manufacturers Association of Nigeria, they've been very vocal about their position on interest rates. They think it's too high, because of course, I mean, it's quite difficult to do business in a country like Nigeria, and then you're getting that if you're relying on bank loans, you're getting loans at over 30%. It's hard, really, that you have to service your loans at 30%. I mean, what's the profit margin, the average profit margin of a Nigerian company? If you have to back out 30% of that just to service the loans you've taken, is quite high. So yes, they're still high, but we understand what the central bank is doing. The truth is, like we said earlier, it's important that you set the economy on the path of orthodoxy, and you send a signal to investors that you are predictable. The central bank's monetary policy is predictable. Predictable monetary policy means that if inflation is at fever pitch levels, then you have to hike interest rates to match that, especially if it's demand pull. Some people will argue in Nigeria that, well, our inflation is not demand pull, it's more cost driven. But the truth is, even at that, because of imported inflation, there's still an impact that having a stable currency would have on inflation, whether it's being driven by cost or demand. So it's only reasonable that the central bank has to hike rates to ensure that you keep prices down, and then you mop up the excess liquidity in the market, which we had a lot of liquidity under the previous central bank governor. So this central bank governor now, Olayemi Cardoso, is probably just trying to roll back some of those policies of the previous governor that knocked investor confidence and led to skyrocketing inflation. So manufacturers obviously would not be so happy about this. Perhaps they would have been expecting a cut. But I mean, on the flip side, at least we're getting, if there's anything that you can deduce from the trajectory this year, is that for sure there might be a rate cut. It's more likely that we have a rate cut this year than a rate hike. So you're not going to see that very hawkish central bank that you saw last year. There's every sense that this time around it'll be a little more dovish, because of the forecast that inflation would trend downwards, which means that it gives them less reasons to keep on hiking interest rates. So if that happens, then of course it would give the economy ample room to breathe, yeah, we'll be the better for it.
And who do you think stands to benefit more from this decision, this MPC's decision?
So generally, since things are still the same, I think investors stand, not especially foreign investors. I've been saying that the rates on treasury bills are low, but I remember last week somebody was telling me that 23% is still good returns, because for a 1-year treasury bill, the rate should be at least a single digit for a year treasury bill. So
because it's risk free.
Because it's risk free.
You're not taking any risk at all.
So for even as a now, even it's still a very good time to still lock in on a year treasury bill, on bonds. I would expect that there's a bond auction today. I would expect that today a lot of people, like, there's an oversubscription on the bond, because people should lock in on these yields currently. So for investors, and you already mentioned that we are in an era of positive real returns. That's something that even foreign investors would be very interested in. And given that we have a stable currency right now, naira is about 1.5. We don't even have an arbitrage. The black market and the official market they are the same. They've converged like 1,509 and 1,510. So it's a very good time for investors. So they are the gainers to be seen here. And for businesses, I think it's just a good time for, like, some businesses also like invest. So it's a good time for them to invest ahead of time. And then furthermore, they might enjoy from the rate cut, like you said, that there's going to be a rate cut. The next by the next MPC meeting, would have seen, I think it's in May, would have seen February, March, April inflation rates, and we'll be able to tell from then. And I'm sure, like, things will be better, and there will likely be a rate cut. So for now, it's investors, foreign investors, local investors that are at the receiving side or the advantage of.
So investors basically.
Yes, and literally everyone should be an investor. So, like, I think everyone could actually benefit from it.
And depending on how you look at it, even Nigerians can benefit from this, the economy as a whole, right? Because you get the sense that what the central bank is trying to do is to stabilize prices, right? Stabilize inflation and ensure that you have a stable exchange rate, price stability, which is essentially the core mandate of the central bank. So if that works out well, then obviously the economy will benefit from that, and Nigerians as well. So, but I get the flip side that interest rates are too high for some businesses, but you know that people are getting creative these days. There are so many other sources of funding. Most companies are turning away from bank loans and exploring other opportunities like private equity, for instance. Some companies are doing commercial papers, although the companies that can do commercial papers need to be of a certain size.
Yes.
Yeah, the big ones. But you could do private equity. There are other options, venture capital. There are other options aside bank loans, really. So hopefully, what the central bank is trying to do, they're able to achieve it, and then the economy is on the right footing.
And when you speak of the economy being on the right footing, so last week we had a guest on the show who had spoken, Mr. Ayo Teriba, and he had mentioned that there's nothing for us to be happy about. When we're talking about how the naira has been on a stable since January, we've seen a stability. Yeah. What are your thoughts on this?
Well, I think that however way you look at it, it's positive that the naira has been stable. It could be a lot worse. A lot of people went into this year expecting that perhaps the naira could even hit 2,000 naira, right, to $1. But we've gotten that pleasant surprise. Things are stabilizing. However way you look at it, the Trump's presidency was also supposed to be a threat, because it was supposed to enthrone a stronger dollar, which would, lead to capital reversals from emerging markets as well back to the US. But Nigeria has been able to manage that fairly well. The naira has been fairly stable. And I think that the central bank has learned from the last time, late last year, when the naira went on this remarkable rally, went from worst performing currency to the best performing currency in the space of months, and was as high as 1,003 at the time before it came crashing back down to 1.6 or even almost 1.7. The central bank learned at the time that sometimes if you get carried away by that appreciation and you're not really an active participant in the market, which would mean buying dollars as well. So if you have the opportunity as a central bank to buy dollars at a cheaper rate, you should mop up that liquidity rather than just let it float around and then the rate just keeps appreciating, and then it gets to a point where the liquidity dries and the naira flushes around. So now I think that they're keeping an eye out for liquidity in the market. They're not getting carried away by just the stability in the exchange rate. They're looking at liquidity and ensuring that there's enough liquidity in the market to ensure that even if the naira doesn't go on some sort of a bull run from here on, it is still able to maintain, that tight band of between 1,500 and 1,510. So yeah, so exactly overshoot that. So it's positive however you look at it. But what will be decisive is that we don't repeat the mistakes of the past. Where the naira just goes on this rally, we're not thinking about liquidity so much, and then the liquidity dries up all of a sudden, and then the naira just crashes. If there's a change of tack in that regard, then of course we would have much to celebrate.
Yeah. And just before I let you go, Enola, I know you did write a story talking on the CPI and the rebasing and all of that. Just for the viewer who is not too familiar with what this is, what does it actually mean, when you talk about the consumer price index rebasing and all of that?
So the rebasing just generally means that, so there were a couple of adjustments made to the methodology. The most important one is the year to which it was it's rebased. So previously, the inflation prices were rebased, were compared to prices in 2009, but now the prices are compared to prices in 2024, which was last year. And according to the MBS, their reasons because in 2023 there was a floating of the exchange rate, and there was also like subsidy removal, so prices are more like reflective of current situation, so to speak. So say in 2009 a shirt costs 5 naira, and if you compare it to prices now, there will be great margin between that price and now. But say last year the shirt was probably 500 and now it's 600, so we see why there was a reduction in inflation figures. Also, so there are a number of items they normally take statistics of every month. So those items were about 700 in the past. They increased those items to 900, also to reflect current reality. Some people, we spend more on several other things that we do not used to spend back in 2009 when they were using the previous methodology.
Like
data, financial services. Now we pay like things like ATM charges. Sure. You are using piggy vest, all those financial charges we didn't used to pay back then. Some other ingredients, some other items that are also important was added. Then there's another divisional level. That's where all these items are grouped into a subheading. So there were 12 of them before, it became 13, and now financial and insurance services was added to it. So another thing to note is that the weight of food, transport, and I think electricity was reduced. I think it used to be about over 70%, and it was reduced to much less than that now. So food is still the heaviest. It's still the heaviest item when calculating inflation, but it's not as heavy as it used to be. So those are some of the things there were some of the corrections that they made, or the new method. That's the way they calculate it currently. So that's why we saw a reduction in the inflation. Now, something to also notice that the fact that it dropped from 34.8 to 24.4, it does not mean that inflation actually reduced. It just interprets that inflation between last year and now, like prices increased by 24.48%. So it's not that because of the methodology, it has reduced to like how do I put it, theoretically
decelerated,
it has decelerated.
Yeah, it's still rising,
but it's still rising, but like it's decelerated. Yeah. So it just says that between last year January and now, inflation prices has increased by 24.48%. That's what's the new methodology.
All right, so finally, Mr. Lolade, what right now for people who want to borrow money, is this a good time for people who want to borrow money?
Well, we talked about it earlier. Truth is, the interest rates are high. It's definitely not a good time to borrow, to go get a bank loan. You know what I mean? It's not. Especially given that there are forecasts that rates will start to come down. There's likely going to be a rate cut, 1 or 2, before the end of the year. So if at all you want to rely on bank loans, this is not the time to take new bank loans. You probably want to wait till when the rates start to trend downwards. For now, I think what people should be thinking about should be how to take advantage of the high yields in the market. Because when you have high interest rates like the high MPR, then it means that you also have high market rates, high market returns, So they should be thinking of ways, Nigerians should be thinking of, people should be thinking of ways to, take advantage of the high yields in the market right now, because they would not last forever. You might start to see a winding down this year. Eniola did a story last year about the T-bills market and how the party might be over, in some sort of way, that because yields have dropped from about 25% to 23%. 23% is still high. Yeah, maybe the party is not entirely over, but you get the point is that this might be the beginning or the first sign that the party is nearing an end, right? Because you're coming from, in January 2024, the yields on T-bills, the one-year T-bill was about 9%. So it's likely that we start to return to that era if we're able to keep a lead on inflation, and that would mean that these high yields that are easily accessible now will be no more. So that's what the focus should be, really, not necessarily taking bank loans at this time.
I also want to add that so in the bond auction today, in January, there was a new bond that was opened at 22.6. That's the highest coupon ever. They did not add it to this auction. So the government, they're really trying to reduce their spending, so yields are decreasing. But I also want to add that it might also be a good time to start investing in the equities market. Because theoretically, when interest rates start to come down, the equity market starts to perform well. And when is the best time to buy? Is to buy when the market is still relatively
on the low side.
Yeah, on the low side. So now might be time to start investing in the equities market too, aside locking in on high yields.
Yeah. Although the stock market has been, Nigerian stock market has been swimming against the tide, if you like.
Yeah.
Like as you said, theoretically, when interest rates go up, the stock market tends to, because it means that the finance cost for companies listed on the exchange goes up. So it reduces their profitability, and then that also kind of dampens their attractiveness to investors. But we've had a situation where Nigerian stocks have been doing well, irrespective of the high interest rate environment. So it's only normal that if rates even come down this year, then it's even likely that the stock market will do better. So so people should focus more on investments now, rather than taking up bank loans. If you must take a loan for working capital or anything, I'd advise you explore other more affordable sources than going to the bank.
Well, we've heard from the experts. It's a good time for us to invest. So thank you very much for your time on the morning show this morning. And you're Latunji, banking and finance reporter here at Business Day, as well as you, the Akimurele, our deputy editor here at Business Day. It's been a pleasure speaking with you. And that's how we bring it to a wrap here on The Big Story. My name is Elizabeth Musa. Do stay with us for more.